Hello and welcome to the LLC Advantage. Today, I want to talk to you about wealth management and how it might fit into your overall financial needs. At LLC Private Wealth, we look at we treat our financial offerings in different pillars with different people on our team having specialties in different areas. And my area of specialty is mainly the wealth management side of things. I've been a portfolio manager for almost 25 years and been with Canaccord Genuity since 2006. Actually, one of the first portfolio managers on board, helping build the platform here, and building how it fits into people's portfolios or their financial goals. We take a very comprehensive approach to wealth management. And one thing I want to stress, it's not an all or none strategy. It's meant to combine the different strategies, the different goals that you're going to have. Of course, we look at financial planning, estate planning. Taxes is vital importance to consider in any portfolio strategies, but really risk management, how you're using risk to grow your investments, or how you might not want to use risk, depending on where you are and what stage you're at. But how to blend it all together to meet those goals and meet those needs. My background, as I mentioned, I've been with Canaccord since 2006. I'm the only Canadian, or the only the only Canadian for Canaccord to serve on our UK investment committees. Those investment committees run just over 50 billion in assets. They've been award winning for many years. They've done some fantastic work, and I think they bring actually a institutional approach to individuals' needs. And we've been able to bring that back to Canada and create a portfolio solution where we can give you a bespoke or tailor-made approach, as opposed to kind of a general fund, or you're just in a specific model, but actually bring portfolio management to your individual needs, without giving up the institutional benefits of having a wealth manager or portfolio manager helping you manage a component of your assets. As I mentioned, also, I was the first portfolio manager for Canaccord. So I've been instrumental in building out Canaccord's platform, including our external managers that are offered on our platform. So I've had years of doing due diligence on different expertise, different styles, and how that all comes together to meet an individual's needs, or how we can bring it together to meet your needs specifically in your investment philosophy. Canaccord is a global company. We have, as I mentioned, our UK offices all over Europe, Canada, the leading independent here in Canada. Australia has been a growing factor for us, especially over the last 5-6 years. We're able to pull on all those resources to bring a really global approach. Even if your portfolio is looking domestically, it's important to know what's going on around the world and how that's going to fit into things in the long term. Our approach is a bit different. If you've looked at wealth or wealth management, or you've used the wealth manager before, you might be used to what we call the benchmark approach. Ours is very different in the fact that we look at risk first in a portfolio. And I'll explain a little bit what that means, because it's really important to understand how the LLC Advantage is different than you might have seen out there before. So a benchmark approach, pretty simple. You pick a benchmark. It could be anything. It can be a blended benchmark. The easiest to talk about is, the S&P 500, and say, okay, I'm going to be benchmark to the S&P 500, meaning I have to have weightings of whether financials, or whether it be technology, whether it be energy, whatever the benchmark's weighting. If the benchmark's weighting is 10%, I should have 10% exposure to that sector of my portfolio. Now, benchmark managers generally are allowed to overweight and underweight their benchmark, but it's usually limited to 10% of that. So to vary or to overweight or underweight a 10% exposure by 10% means I can be up 1%, so 11% exposure, or down 1%, 9% exposure, which really doesn't give you a lot of protection when it comes to volatility. And what does that mean? Because volatility is a big part of your performance in a portfolio, especially if you're talking about longer term investment goals. So just to give you an example, and this is fictitious, I'm just talking about the difference between a risk first, or what we call a tactical approach, compared to a benchmark. So a benchmark approach would be if you start with $1 million and right out of the gate, the market falls 20%, your portfolio is going to go down to $800,000. In a tactical approach, the goals would be to prevent as much of a drawdown. So how can I limit my drawdown using a tactical strategy? And let's say you manage to only go down by 5%. So you're still down to 950,000 at the bottom of the market. Now, when that market recovers, whether it's a month later or a year later, when that market comes back up that 20%, that $800,000 investment, you're not hitting a new high. You're not back to $1 million because you only had 800,000 working for you at the bottom. In fact, you're only at 960,000. So the market's fully recovered and you're still underwater in your portfolio. With a tactical approach, even if you only got 10% of that upside, so you didn't get the full 20, that first 10% of the market recovery, we might have seen, heightened risks, heightened volatility. So the portfolio is still being cautious. So if you just got 10% of that upside, you're still at $1,045,000. So a brand new high in your portfolio. And as the market continues to rise, you're catching those returns and you're moving ahead before the benchmark portfolio actually recovers. So now that's as I mentioned, this is a fictitious example. Just wanted to highlight the principle behind a risk first or volatile first type of strategy. So how does that play out in real life? Well, let's take a look at 2022 because it was a great example. In fact, during the year 2022, the S&P fell by 19.5%, so almost your 20%. And by the early January 2023, the S&P was kind of broaching back to previous highs. So pretty much recovered. So let's take a look at our tactical portfolio. And I'm taking our risk profile 6. Again, we tailor make these. I'll get more details in a moment, but our RP6 would be, generally what people would call a balanced approach to a portfolio. So you've got fixed income, you've got equities, and I picked two big balance funds. I'm not picking on these shops, RBC Balance Fund and Fidelity. They're just two big, well-known ones out there. They've got long track records, so it was, something people would be familiar with. And I've plotted them out over that 2022 year and how they performed. And you can see by the chart there, the black line at the top is our RP6 or our tactical approach. And sure, it saw drawdowns. It saw drawdowns of 5.82%, or in that ballpark, when the S&P was down almost 20%. Now you saw the other two portfolios, they're benchmark funds. They took the full benchmark ride. They went down and they started to recover. As I mentioned, they're good shops, they're good managers, but the benchmark approach is handcuffing their managers to those weightings, and they're not able to tactically shift. And in fact, at the beginning of 2022, when inflation started rearing its ugly head really hard and really fast, and of course that's where we saw the Ukraine war start. All that shifted our portfolios. We got to 34% in cash, in cash. So we're high interest investments at the time. But we lightened off on the areas of the market that were indicated through our process higher risk. That enabled us to take advantage of not going down as much and get in that recovery. So we were at new highs before the end of the year and broaching brand new highs in the portfolios well into January in the first quarter, ahead by at least a quarter or 2 quarters before those other two portfolios managed to get back to a break-even stance. So that allows us to outperform. Now, this is 2022. We can graph this out through other years like 2008 or 2020. And in fact, we're going to look at that through the COVID or the pandemic start of 2020. And you'll see how the tactical approach can really, really benefit your longer term returns. And here's no greater example is what does it mean to your bottom dollar, or what does it mean in your pocket? So taking a look at that RP6 portfolio again, a risk profile 6 tactical approach. If you started in August 2019 with $1 million in our portfolio, you have analyzed almost 9%, and that's through 2020 and 2022. Remember, sharp spike down in early 2020 and a big negative year for the markets in 2022. Still averaging 9%. Or 16 million or $1.6 million, sorry, in your pocket at the end of the 5 years. If you would have been in those benchmark funds, the RBC and Fidelity, you would have seriously underperformed. In fact, you'd be almost three or at the high end, 300,000 behind. So that means $300,000 less in your pocket on that same initial $1 million investment. RBC did a little bit better, but 240,000 behind, but still a big impact on your wallet at the end of the day, your investable dollars, and reaching those financial goals, whether it be retirements, other investments like buying more real estate or anything, kids' education, whatever might apply to your particular situation. It's important to, sometimes we get lost in the percentages, but when you look at the underlying dollars, it's important to see what you're missing out on when you're taking that full risk ride. And what I mean by that full risk ride, this is a chart I really love because almost every benchmark manager has used it in its history at some point, and it always tells you, stay fully invested. If you look at this is MSCI World Index, and if you just stayed invested over this whole period, and this goes from 2000 to 2015, it went through a bunch of crises, which is why I like this particular time period to look at from a chart. We had '08, we had all those other things, and you can see by the dark line, if you just stayed invested, you would have made money. You'd be up into the positive territory, and you've been doing great. But if you just missed the 10 best weeks, so if you panicked and got out of the market for just the 10 best weeks, and this is what these benchmark managers will tell you, is stay invested, buy and hold, because you don't want to miss out. So you stayed in just the 10, if you missed just the 10 best weeks, you'd be way down there in the negatives on the gray line. Quite a different variance in performance, and this is where they advertise to stay in their fund or stay in their portfolio. You'll do well. What I like to look at is what if we missed the 10 worst weeks? And if we missed the 10 worst weeks, this is the dark line way up here. How much better you would do than just the index, just by missing out of those big drawdowns, because the moment your portfolio draws down, you have less capital working for you to rebound. Now, it's great if you've got extra cash to throw in and take advantage of it, but if you're pretty much fully invested and you go for that full ride, you're giving up on a lot of returns, which is why we focus on that risk first. We try to de-risk when areas of the markets are offering not enough return for the amount of risk that are in them. We'll back off, and or the process will back us off from putting more money in those areas. We'll start to trim profits out of those areas and try to seek safer harbors, different areas in the market, different sectors, different geographies, whatever might be offering a better yield for the risk that we're taking. Now, sometimes the process doesn't identify anything, and that's where we end up in cash. And in 2000, late 2007, early 2008, the portfolio actually got as high as 65% in cash because it couldn't find a safe harbor. And it managed to weather that 2008 storm really, really well because of that process. Now, how do we do that? What's our process? Well, we use a very vigorous screening process. It's based on quality of balance sheet. We look at income statement strength. Cash flow is king when we're looking at our different screening processes. We look at the company's cash flow, the strength of the cash flow, their ability to duplicate that cash flow, but also, very importantly, their ability to grow that cash flow. We definitely look at sectors. We looked at sectors, micro and macro components. We look at headwinds, tailwinds to see where we see strengths there. We do a bottom-up fundamental research. We look at correlations between asset classes. We do a full review of all the names in there. We use a great quant model that Canaccord built through our UK office, in fact, called Quest. We use an external technical screeners, and we also use third-party research to back up all our views and data to ensure that what we're looking at, we're not being biased by anything internal. We're looking for the correlation across all our different screens. And we take that and we do the same thing with asset allocation, looking at, again, the micro outlook, the macro outlook. We look at those asset classes, headwind, tailwinds. We really look at the correlation between asset classes, because what we tend to see is correlation breakdown as risk starts to mount in a market. So, if two asset classes that normally act separately from each other, the classic example of that, of course, bonds and stocks generally are negatively correlated. But when they start to positively correlate beyond their normal ranges, the market's starting to tell you that the risk reward is starting to get stressed. It's starting to get to a point where you could see higher pullbacks than potential gains, and that's really at the top of our triggers of looking at risk in things. We look at consensus weightings, or we look at all the different weighting recommendations. Again, we use third party. We have internal strategists. We have those UK committees I talked about, and we look for that consensus to see if there's any outliers and why someone have an outlying opinion, and try to really identify again where the risks lie. We look geography across the around the world rather, and we're not tied to sector weightings. So unlike those benchmarks, if we don't like a sector, we can go to zero on it. We're tactical. Doesn't mean we always go to zero on a sector. We might still want to maintain a weight, and even if we don't have a high positive view on it, but we're not stuck to one up or down 1%. If we want to slash the sector in half, we can. If we want to increase cash, or if the process is telling us to increase cash, we do. And we're constantly reviewing this outlook to adjust as the markets and as the economies around the world change. So how do we build that tailor-made or that bespoke position? Well, we basically create what we call sleeves. We create individual focused portfolios. We have a cash portfolio, which is basically just looking for high liquid cash returns. Could be GICs, could be T-bills, it could be money markets. It depends what's paying the highest in there. We have a fixed income sleeve or portfolio, which is, of course, focused solely on those cash components plus using bonds. We have the Canadian equity component or portfolio that slowly looks at Canadian equities. We have a global, it's a US dollar base, but a global portfolio and an all cap portfolio, a bit more torquey, a bit more higher returns, a bit more volatility in the all cap. Not for everyone. Some people really love it. And as I've kind of got them here in this graph on a risk reward graph, keep in mind, these are just indicative returns. These are not exact returns to that particular graph. The idea, the more risk you take, the more return you're going to get. But we can take those individual portfolios and build you your own risk profile, or build a profile that's tailored to you, where it'd be a component of some, all, one, any amount, whatever's appropriate to you, where we come up with that combined portfolio that's going to meet your needs. It's going to meet your growth expectations or growth targets, your growth expectations, and at the same time provide you that risk-first tactical approach that we believe everyone should have in their overall investment approach. We do have, as I mentioned, the different risk profiles, 1, 2, 3, 4, 6, 7 custom. We have different neutral weightings that may apply to you, may not apply to you. that we put together for people. If you have some smaller portfolios, we do have an ETF version, and it uses the same asset allocation, just not the individual stock selection. These are not funds. You actually own the individual positions within each of those portfolios. And of course, we amalgamate it all into one portfolio so you can see what your overall performance and portfolio is doing. As I mentioned before, we are driven by the access that we have to global resources to be able to pull all this together and make it happen within your portfolio. So with that, I just wanted to say thank you for listening. If you want more information, please reach out to us. Our email's llc@cgf.com. You can reach me at mikeonmoney.com. Give us a call. Happy to look at your current portfolio, happy to look at your current investment strategies, and just take a look at how it's doing, how it's working towards your investment goals, and is there something we can help you improve or help you get to where you want to go in a more efficient manner. So with that, thank you, everyone. Enjoy your day, and looking forward to talk to you soon. Bye now.